Credit Suisse, once valued at $49 billion in 2018, has been acquired by UBS for a mere $3.2 billion, which is smaller than a small Italian coffee machine manufacturer. The media has been reporting on the bank's poor performance lately, with Credit Suisse making headlines for its collapse and subsequent takeover by UBS with the support of the Swiss National Bank. But what led to this crisis? And is it a sign of the global banking system's collapse? In this video, let's talk about what just happened with Credit Suisse and what experts have to say about it. Hey friends, welcome to Capitalista. Before we dive in, please take a moment to hit the like and subscribe buttons down below. First of all, Credit Suisse collapse is different from the US banks that have previously failed. It's been a slow and gradual decline caused by numerous scandals and underperformance. Long-term stock charts show that the bank has faced constant downward pressure since the global financial crisis. Last year, Reuters released a chart that perfectly captures Credit Suisse troubles. They've met a string of scandals, from spying on ex-employees to the green steel lobbying scandal, losses from the Archegos default, and failure to prevent money laundering by a Bulgarian cocaine trafficking gang. So it's been a long and painful slide to the brink of collapse. The blunders are making the stock price go down. It's also making Credit Suisse clients and depositors feel more and more disgusted. They don't like the fact that Credit Suisse is starting to look like a shady bank, and this has caused fewer people to want to do business with them over time. So last July, Credit Suisse brought in a new CEO named Ulrich Körner to try and fix things. He devised a new plan, but investors weren't impressed, and it didn't work out. During the fourth quarter of the year, there was supposed to be a big capital raise, but the announcement of a new plan came along with it, causing investors to panic and causing the shares to plummet. As a result, the company experienced a net asset outflow of 110.5 billion Swiss francs. It suffered its largest annual loss since the global financial crisis, amounting to 7.29 billion Swiss francs, or approximately 7.89 billion US dollars. Things weren't looking great for them after a rough Q4. And to add insult to injury, the chairman of Saudi National Bank, Credit Suisse biggest shareholder, made a statement. The statement confirmed they had no plans to purchase more shares in the Swiss bank. They reasoned that they wanted to keep their ownership below 10% to avoid additional paperwork that comes with having a larger stake. The collapse of Silicon Valley Bank and the sudden concern over the global banking system caused Credit Suisse shares to drop by 20% in just one day. This news and others led to a multifaceted death spiral that had been building up for years, characterized by scandals, poor performance, customer withdrawals, large losses, and investor concern. It was so bad that trading was halted. Credit Suisse was in big trouble, and it happened quickly. Suddenly, hope emerged as a lifeline. On Thursday, March 16th, the group announced that Credit Suisse is taking bold steps to boost its liquidity. They plan to exercise their option to borrow up to 50 billion Swiss francs from the Swiss National Bank using a covered loan facility. Additionally, they will tap into a short-term liquidity facility fully collateralized by top-notch assets. In other words, Credit Suisse is taking proactive measures to secure its financial stability. So, they approached the Swiss Central Bank and sought assistance, and fortunately, the Swiss bank agreed. It was a brilliant move on the bank's part because it helped ease the immediate panic regarding the possibility of another liquidity crisis, which could have triggered a bank run. The Swiss bank didn't just save the day and call it quits. Nope, there's more to the story. Credit Suisse announced they'd merge with UBS, and with the help from Swiss authorities, it became a reality. The Swiss National Bank even issued a press release saying that UBS had taken over Credit Suisse with the backing of the Swiss federal government, FINMA, and the Swiss National Bank. This takeover helped to stabilize the financial system and protect the Swiss economy during these challenging times. And both banks now have access to the SNB's facilities for obtaining liquidity, ensuring they have the necessary resources to keep things running smoothly. According to the guidelines on monetary policy instruments, UBS will purchase Credit Suisse for 3 $3.2 billion, and each Credit Suisse shareholder will get 1 UBS share for every 22.48 Credit Suisse shares. It's a positive result because the bank can carry on running smoothly. This merger is great news for the future of the banks. UBS is making a strategic move here, and Credit Suisse benefits from it. Shareholders from both banks are happy about it. However, the Credit Suisse deal isn't flawless. Recent headlines show some bondholders are upset with the news that the Swiss regulator FINMA or FINMA announced. As part of the deal, 81 bondholders would lose their investments. This is strange because bondholders usually receive payment before common shareholders. While shareholders are not doing great, they are still receiving something. They are receiving 1 UBS share every 22.48 Credit Suisse shares. On the other hand, the 81 bondholders are receiving nothing. Even though it's not perfect, the general consensus is that it's probably the smoothest solution available. The main concern is whether this is a domino in a larger worldwide banking crisis. Even Michael Burry and other investors have recently echoed similar sentiments. Recently, he took to Twitter and said that the crisis could be resolved quickly, and he doesn't perceive any real danger. On the other hand, Steve Eisman, who was featured in The Big Short, stated on CNBC that he doesn't believe another 2008 is imminent. Looks like we're not headed toward a full-blown banking crisis. Here's why. First off, the banking system doesn't seem to have any major underlying problems. Interest rates are rising and some people are struggling with cash flow. But that's not a widespread issue affecting the whole system. Instead, banks like Silicon, Silvergate, and Signature failed because they took big risks in specific business areas and didn't manage their interest rate exposure properly. When their customers wanted to take out their money, they had to sell their investments at a loss to meet those demands, leading to their downfall. Credit Suisse situation was different, but still not a systematic problem. It was simply a badly managed bank that had been deteriorating gradually, and things finally reached a breaking point. Number 2, it's crystal clear that central banks worldwide are closely monitoring the matter. They're poised to intervene without hesitation to prevent a loss of faith. The FDIC, Treasury, and Federal Reserve announced that they would guarantee all deposits at Silicon Valley Bank and Signature Bank despite regulations stating that they're only responsible for ensuring up to $250,000 per account holder. The Bank of Canada, Bank of England, Bank of Japan, European Central Bank, Federal Reserve, and Swiss National Bank are all working together to boost liquidity through US dollar liquidity swap line arrangements following the Credit Suisse situation. These joint efforts aim to support the banking sector and prevent bank runs, giving investors a sense of security. And so, it appears that this is not as serious as the 2008 financial crisis. So, what's your take on Credit Suisse failure and early remedies? Share your thoughts with us in the comment section down below. And that's it for today. Make sure to show your appreciation by giving a thumbs up, subscribing to the channel, and turning on notification. This way you'll always be in the loop and never miss out on any of our uploads. Until next time, and take care.